Hi, everyone. Welcome, everyone, again. It's great to have Jay again with us for another session. On his last musing, his last report, he talks about some great quotes from his former boss, who was a legend on Wall Street, Barton Biggs. So why don't we start, with a couple of those that you mentioned, and then Jay, we can start from there.
Sure, Roberto. Great to be with you again. I mean, time is passing so fast with all the action in the markets.
That's
it
right.
seems like we did the last live like 2 days ago, as opposed to 2 weeks ago. It's amazing that it's already been 2 weeks. So yes, I did. I titled the musings on Friday. Wednesday, March 16th was a very big day, and it seems that in this environment, cliches are kind of coming fast and furiously. And I thought back to my days at Morgan Stanley, where I learned how to be a sell-side strategist from two of the best, Byron Wien, who's still active at Blackstone, and Barton Biggs. And Byron was the one who told me that you can give a level, like where you think the market's going to go, and you can give a date, whatever time frame you want, but you never give both the level and the date in the same time. And I thought that was a really great advice for a sell-side strategist. And then Barton's comment that really kind of stuck with me when I was thinking about the musings was that the news doesn't have to get better, it just has to get less bad. And I think Wednesday marked a day where not just on one level, but on 3 levels, the news got less bad. And I think that helps explain why we had such a powerful reaction on risk assets last week.
Yeah. No, and the other quote I remember from him is exactly related to this. And he said that the bear market ends when at the moment of maximum bearishness. So I guess we can say that was the case with respect to China, right?
Well, I mean,
everybody had a reason to sell.
Yes, well, people have had reasons to sell China for a good 6 months now already, since the summer, with the focus on some of the big tech companies, and then the real estate story with Evergrande, and all the rest of it, the worries about power supply, etc. But yeah, China has been a disappointment. We have been overweight Chinese assets in our global multi-asset model portfolio for the last couple of months. And so it's actually been a tough slog. But I think on Wednesday, the Chinese government came out and spoke very powerfully about how it wants to be on the good side of the markets. And they pledged to keep capital markets stable. They vowed to support overseas listings. They said the dialogue on the US ADRs is a good dialogue. They promised to handle the risks on the property development side, and they clarified that regulation of tech and all of that in one day. I mean, you can't really get much better than that. Not only do you have, a very supportive policy backdrop in China with monetary policy easing and fiscal policy available to support growth efforts, But now you have the government coming out and basically putting their own credibility on the line to support markets and to support investors, both domestic and foreign. And that is a pretty extraordinary event, I believe. And as I said in my musings, I think the different decisions that were made on Wednesday are going to take time for investors to fully appreciate. But in China's case, obviously, it reacted very, very quickly, right? You had an absolutely unbelievable 40% rebound in one day in KWEB.
I never seen anything like this in my career. Mega
40%.
cap stocks up 40% in a day. Never saw it.
40%. It's an ETF. It's not even one stock. It's an ETF.
Yeah.
And the volume was just, off the charts, 100 plus million shares traded. Shorts obviously covering feverishly. Some people may be deciding to go long a little bit. But to me, that was not just, they didn't just come out and say that, right? I believe the date was planned. They did it in front of the Fed. They wanted maximum attention. They took the Fed completely off the front page, which is really hard to do, right? Because it was the Fed starting a rate hike cycle for the first time in 4 years. And yet that was the second story of the day. So to me, this was not a, loose lips conversation. This was not a off the cuff commentary. This was planned. This was scheduled. This was meant to have maximum impact. And I believe that it got that maximum impact. And now, of course, we need to see policy action by the Chinese authorities across this whole range of subjects that they spoke of. And I believe that's going to happen. And so I think from my point of view, the China stock market, which has been, beaten up badly, is a real opportunity.
Yeah, and I agree, and I would say that China never does anything. They always plan everything. So it's never off the cuff conversation, as you say. It's never accidental. So of course, they picked a date which was to eclipse the Fed, of course, they picked a date, but why have they decided to do it now? Is this a response to what's happening in Russia? They, as you kind of indicated.
I think so. JP Morgan, as I mentioned in my musings, I like JP Morgan's work. Their macro work, I think, is very strong. But they had two reports out last week. The first, I think, either over the weekend or Monday, was calling Chinese tech basically uninvestable. And then on Wednesday or Thursday, their global strategist came out and said, buy high beta. So it's kind of like, wow, pick whichever one you want. But I believe that the Chinese government saw what was happening to their tech sector, it was going down. KWEB was going down, 8 to 10% a day, back-to-back days late last week and on Monday. And I believe the authorities in China saw what uninvestable means in 2022. And it means, look at Russia. And Russia has been virtually completely taken out of the global financial system in the space of less than a month. And obviously, it would be much harder to do that for China. But China also needs the international investment community much more than Russia does. And so I think they really got spooked and realized they had to kind of shore up the system a little bit and support it. Because you do not want to be uninvestable in 2022. Because as we've seen, it can happen very, very quickly. And there's very little that you can do about it if the market decides that, in fact, you're uninvestable.
Yeah. No, so, given that you talked about the Fed, let's go to Russia first, which is, you also mentioned in the musings that time is not Putin's friend, and obviously things are not going the way he expected. It's you look at what's happened in Mariupol, and it's taking a lot longer. So, is has your end game for the war changed?
Well, I think that's the second, big event on last Wednesday, on the 16th. Right, there was the first day that it came out that there were real concrete discussions going on between Russia and the Ukraine over what a ceasefire would look like. And so that fits in with my kind of timeline. I think the timeline for some sort of a ceasefire, a negotiated settlement, is quite short. And I think that's the case, particularly for Russia, given that Russia is, as you point out, not being successful militarily, politically, socially becoming a big challenge in Russia. More and more deaths on the battlefield, more and more resistance, even on their own state TV channel, where people are popping up and photobombing the state TV news channel. And then economically, where Russia's dependence on imports for things like its car production facilities, et cetera, is really already manifesting itself. The leading Russian automobile maker has already had to cease production at one of its big plants because they don't have the parts. So people are being sent home. So whether it's militarily, politically, economically, time, as I said, is not Putin's friend. And so I think I've been of the view that I thought China could play an important role in helping to bring Russia to the table. And I had hoped that the call between President Biden and Xi late last week on Friday would actually lead to something like that happening. And so far it hasn't. And actually the public readouts have not been that supportive of that idea. But I wonder what's going on privately in all the back channels that are taking place. Because I think the worry is that as every day passes, the outcomes for Russia become less and less appealing. And again, across all spaces, military, social, economic, the outcomes become worse, not better. And so I'm not exactly sure how it ends up, but I do feel pretty confident that the timeline for some sort of a negotiated settlement is relatively short. And I said a couple weeks ago, I thought it could be a few weeks. So that clock is kind of ticking right now as we speak. But I would think that within, again, another couple weeks, that we will have some sort of a settlement. And I think markets have effectively already started to price that in. If you look at the energy markets, oil today back at 116. If you look at the natural gas market in Europe, has come down dramatically. So the idea that Russia or the Europeans would cut off Russian gas seems less and less likely. I mean, I guess it could be a last-ditch effort by President Putin and the Russians to do that. But I think what's more clear is that their foreign exchange receipts from selling energy are becoming smaller and smaller, and their costs are becoming greater and greater. And so those things really don't match up very well. So I still have the view that China could play an instrumental role in helping Russia come to the negotiation table and make a deal. And I think the Ukrainians are ready to make a deal because they see their country being bombed into back decade. So they're ready to probably make a reasonable deal. And of course, as we know, though, it all depends on President Putin and what he's willing to do. And that's where I think, again, the Chinese can come in and help that role. Because otherwise, I think there's the very real risk that rather than Ukraine becoming a vassal state of Russia, which I think was the objective here by President Putin, it's becoming increasingly likely that Russia is going to become a vassal state of China's, where all they're going to do is basically be a natural resource exporter to China. And that's not where I think the strategic desire of the Russian government, leadership, what have you, that's not what they want to see. And so, again, as every day passes and they get isolated and cut off from more markets, you're even seeing now Halliburton and others saying they're not going to facilitate additional energy work in Russia. And these are the guys who help Russia extract the oil
Yeah.
in Siberia and elsewhere. That stuff is not just dropping, a pipe in the ground of Russia's oil. This is big, technically advanced, hard stuff that only Halliburton and a couple of these other firms have the capability of doing, and they're telling the Russians that they're out. So I think there's a lot of reasons to hope for some sort of a negotiated settlement fairly soon. And that was the second big piece of news that came out on Wednesday. So first, China saying, look, we see what's happening to Russia. We don't want that. We're backing the markets. We're backing growth. Xi understands he needs growth to support himself in the political environment in China. And he wants that third term coming up in the fall. They're not going to do anything to reduce the likelihood of that growth taking place. So their ability to kind of side with Russia, which is, generates about 3% of their trade, against the US, Europe, and Japan, which represents 50+% of China's trade, it's a no-brainer. And that's why I said in the musings, it was really the only call that President Xi could make, and I think he's made it. Now, how that translates into some sort of a resolution in the Ukraine remains to be seen. I think it's likely to happen. And then, of course, we have the third shoe that fell on Wednesday, which was the Fed.
Yeah. And to finish on China before we move on to the Fed, could we expect some policy actions throughout this, at least the rest of the first semester, so that can bear fruit, before the elections? I'm not sure if they are in October or November.
Yes, I believe November, and yes, I think so. I mean, I think it's going to have to happen, otherwise the pressure is going to return. So they've now said they're going to do these things and support these different entities, and they need to demonstrate that. And I don't think it necessarily has to come this week, but over the next couple of weeks, the next month or so, I think that's going to be likely. And of course, we have the COVID outbreak in in China, which is significant. But as we've seen, China has a great ability to isolate these situations very, very quickly. And I noted that last week they reopened parts of the Shenzhen and Shanghai areas, working on a kind of a bubble policy, much as they employed during the Olympics. In other words, these big factories are almost like towns with dormitories, et cetera, and they've just put a bubble around them and said, okay, you can't leave the bubble for the time being. And that's the kind of targeted approach that I think people in Europe and the US don't really get. And so we're worried about massive lockdowns that are that's going to throw China into reverse in growth terms, versus a much more targeted policy approach to COVID, mass testing, et cetera, that we're not really familiar with in the West. And so I think that the COVID issue is obviously an issue, but I believe they're going to work through it. And I think that there will be policy measures, whether it's targeted support for developers, or whether it's rate cuts, which I think is probably quite likely, whether it's some sort of edict on Tencent and this big fine that Tencent is supposedly about to have levied upon it, and then saying, okay, that's it, we're kind of done with that for the time being, to allow some of these companies to kind of breathe again. I think all of those things are probably quite likely. And so again, that's the kind of thing that gets you off a bear market and gets you back towards, a viable market where people are saying, okay, we see this, then we see this policy action, we see the next policy action, and prices, respond accordingly.
Mm-hmm. Yeah, and how then? Moving on to the Fed, I mean, what you make, and then going to another quote. I mean, I'd like to introduce the question with that quote, which is, people don't mind, a hawkish Fed. What people don't like is a Fed without credibility. So I guess the markets went up nicely despite the hawkish tone. Do you agree with that?
Not really. I saw the market reaction to the Fed last week as more as the Fed was marking itself to the market. And, let's remember that the Fed did not meet in February. So its last meeting had been late January, and we've had all sorts of things happen since January. And so the Fed needed to kind of get back in line with the market. And I believe it did so, right? It came out and said there's basically, a decent likelihood of rate hikes every meeting. That was right in line with where the market was. And they lowered their forecast for growth and raised their forecast for inflation. So people were saying the inflation target was a joke, and they marked it to market and came out with a new one, which is much more reasonable, I guess, given where we are today, having had the energy shock and ag shock as a result of Russia's invasion. So to me, the Fed and the market are now much closer aligned with how they see the next year or so playing out, right? And then after that, we have the issue of the market is expecting us to go back to the pre-COVID kind of growth trend of about 2.3% for the U.S. in the 5 years up to 2019, up to and including 2019. And I think there's a chance that we have higher than that growth. And so that's a subject for kind of another day. So for me, the real big impact of the Fed meeting was that they have marked themselves to market, both in terms of the dot plot and their economic forecasts. And they've lifted off. And so now we're kind of through all that uncertainty. And again, markets hate uncertainty. So what we saw on Wednesday, why I think it was such a big day, and we'll remember and look back at it and say, wow, that was really powerful, was that we cleared not one, not two, but 3 areas of uncertainty in one day. So we cleared what was going to happen in China. Okay, that's now, I think, been decided. We cleared what is likely to happen in the Ukraine, that a deal is going to be doable. And we got the Fed off of ground zero and lifting off and putting a dot plot that the market can look at and say, yeah, okay, that's kind of where I am. So we're fine. We're in alignment. And so we had the natural reaction of an oversold, deeply negative market that had huge short positions in things like ARC and technology in general and in China. And we had a massive reversal. And I think the reversal is really important to contemplate when you're trying to think about, where do we go from here, right? We had, the data is very evident. We had a 11-day period where the VIX was over 30, 11 days in a row. That's very unusual. We had the MOVE index in the U.S. Treasury, the U.S. Treasury Volatility Index was over 100 for day upon day. So those have now come in, and that shows me, at least, that the uncertainty around the Fed's actions has calmed the market, right? The MOVE index is now well under 100. The VIX index is now like 23 or 24. And what happens after you have those periods of high volatility is pretty clear. The history is very supportive of further equity gains over 6 and 12 months. And then we had on Thursday and Friday, we had 4 days in a row of the S&P up 1% or more. That's only happened 5 times in the last 50 years.
Yeah.
5 times in the last 50 years. And every time, 6 and 12 months down the road, the market was higher. Okay. And similarly in NASDAQ, we had a very aggressive, the most aggressive 4-day breadth thrust in the last 20 plus years. And that too suggests that you have higher equity prices 6 and 12 months down the road. And so to me, it's not only the event itself, but it's what happens after. And again, history is not always, doesn't repeat itself, et cetera, et cetera. But when you have something that's happened 5 times in 50 years, so once a decade, type of equity move in the S&P, then I think that suggests that one needs to pay attention. And so to me, as I said, we cleared away a lot of uncertainty. And now I think we can start to focus back onto the idea of a global economy that is still early cycle, that is coming out of COVID. I continue to think that COVID's ebbing and the global reopening is going to be much more significant than the effect of Russia's invasion on the Ukraine in terms of economies. And that is something that got completely swept off the front pages, right? And even in the Fed statement, I saw this the other day, the Fed, for the first time since March of 2020, did not mention COVID. Instead of COVID, they mentioned the Russia invasion of Ukraine. And so truly, Russia's invasion took COVID off the front page. And my point is that people are underestimating the impact on growth and the beneficial impact, I believe, on inflation from COVID's ebbing, as people can go back to work. And so wage gains can moderate a little bit.
Yeah.
Supply chains become less snarled. So prices paid become lower. And all the things that people are worried about on the inflation side can maybe take a step back over the next couple of months. So I continue to think that in the coming quarters, we're going to have better than expected inflation, better than expected, i.e. lower, and so lower than expected inflation and better than expected growth, because people have just completely forgotten about COVID, the ebbing of COVID and what it means. And, certainly restaurants, airline bookings, travel plans, all these things suggest a tremendous pent-up desire amongst people all around the world to get out and do things. And so I expect that to be this story as we clear the uncertainty of Russia's invasion, the Fed liftoff, and what's happening in China.
Yeah, it's great that you talk about this, because I guess you're the only one in the market saying this, and I totally agree. No, it's true, and because I was going to use that to make reference to another point which we discussed before, and that's the bond market. So what the bond market is telling. So one example of confirmation bias, maybe what's happening in the bond market. With analysts today with respect to the bond market, because they only look at the 2 to 10 year ratio, yield differential, and not looking at some other indications, indicators that will tell you that a recession is not that likely. So how do you make that up?
Well, I think there's a lot to unpack there. There is, first of all, the yield curve inversion, right, that everyone is waiting for, like, so I can see it and then say recession, and then that's all you have to do. If it was only that simple, right? If all we had to do was wait for the inversion to clear recession and say that's it, that would mean we could go to the beach. It's becoming spring in the city here in New York, and so beach is coming. So that would be wonderful. I could go to the beach, but I don't think it's that simple. I do think that you have two yield curves that are saying very different things. The 2 and 10 is approaching flat, right? It's like 20 basis points. But the 3-month and 10-year is as steep as it's been in quite some time. And that, from my understanding, I'm not a bond guy, but my understanding is that the 3-month versus 10-year, that curve is got a better prediction rate, better hit rate with recession than the 2s, 10s. So that's something we need to put in there in the mix. The second thing would be that, we've had a dramatic spike in the 2-year rate. It's gone up it was like 50 basis points or something in December. And here it's over 2%. We've had like 150 basis points of backup in the 2-year. So I think that, and that's the most aggressive steepening pre-Fed movement in at least, I think, 30 or 40 years, going back to the early 80s, so 40 years. So the market has done a lot of the work already, I believe. And so then you get to the whole idea of, are we going to have a recession? And, some of the big banks are out there highlighting the odds of a recession, the odds of, or what's priced in, sorry. JP Morgan's work recently suggested that roughly 80% odds of recession are priced into European equities. 80%. I think it's highly unlikely that we'll have a recession in Europe. The ECB just last week with their meeting came out with their new forecasts, and they're forecasting 3.7% growth this year in Europe. JP Morgan just came out with its new estimates, and they're forecasting 3.2% growth in Europe. And as a reminder, in the 5 years up to and including 2019, European GDP growth didn't even average 2%. So we're still talking about well above trend growth in Europe, not a recession. And then you have the case, well, if you have a recession, then you're going to have a bear market. And I think it was Bank of America, their fund manager survey, which people love to look at, I think 60% of respondents in their latest survey said they expected a global bear market in equities this year. 60%. So, that's where the market is at this point. I think it's just, I think the recession call is way off base. I think what we've had the traditional midterm correction in the U.S. It's whether it's completely over, I don't know. I think so, but I'm not a technician, so we'll find out. We need some time to work through things. But to me, the odds of a recession in the U.S. is very low. I mean, the Fed, they revised their numbers, and their number is 2.8% growth in the U.S. The consensus is somewhere around 3.3% growth. Keep in mind, the 5-year average pre-COVID was 2.3% growth. Again, both the U.S. and Europe are likely to grow above trend in 2022 and in 2023. I mean, the ECB forecast for 2023 growth in Europe was 2.8%. That's well above the pre-COVID trend rate. So this is what I mean by people are missing the implications of where we're coming from. We're coming from high growth and where we're going. The whole point that you and I have spoken about for months, slowing growth is not slow growth. We're slowing from an unsustainable level because of the stimulus in the U.S. especially, and now we're stabilizing, I believe, at an above trend growth path. That remains to be seen whether we truly stabilize and at a higher growth path than pre-COVID in the out years 23, 24, 25. I believe it's likely. It's quite possible. Market really disagrees. You look at bond expectations, inflation, growth expectations out the next couple of years, they're basically back to the pre-COVID. So we're just going back to 2019. I don't think it's going to be that simple. So there's a lot that we have to work through. And I would say that even today's action is kind of supportive, at least I think, of my view, because we had 15 basis point backup in the 10-year. The 10-year is now at 230. Remember, we were struggling to get through 2 like 2 weeks ago. And amidst all this uncertainty, we're at 2.3 today. And the markets, after very strong week last week, right? 6% growth, I think, in ACWI, not just in the S&P, 6% in ACWI. And the market barely sold off today. So that tells me that the bond market, I think, is sniffing out the growth that I expect in the next couple of quarters. And that's what's pushing the long end up. And to me, that is equities are fine with that. Higher interest rates, if they're coming because growth is going to be strong, higher rates at the long end, I think the market can absorb quite well. And it supports the idea that the correction we've had is rotational, meaning from growth to value, as opposed to
That's a great point,
systemic,
yeah.
which means it's going to be a bear market. And I think that's the way things seem to be shaping up to me.
Yeah. So, and it was interesting because your former colleagues at Morgan Stanley, they were saying today that this is actually a bear market rally and not, and we're not still in a bull market. So that's very interesting.
Well, I think Mike Wilson at Morgan Stanley has been negative and been bearish
Yeah.
for some time, and it's interesting. He could have used this moment as a chance to get off that view, and he didn't. So he's doubling down. And again, I was a sell side strategist at Morgan Stanley for many years.
Yeah.
I know exactly how that process is done, and he has been right on the correction. People like me who have been pretty constructive throughout the whole last couple months arguably have been wrong, but we let the portfolio speak, and the portfolio is in pretty good shape.
Yeah.
So we're not all that concerned about being wrong, so to speak. But it's interesting that Mike did decide to not get off the bearish call, but double down on it. And we'll see. That's what we need. That's what makes the market different points of view.
Different views, yeah. No, yeah, no, definitely the portfolio always speaks for itself. And but moving on, I mean, let's talk about the opportunities because as we agree, the market. There's a lot of people who think that inflation is around the corner. Sorry, a recession is around the corner, and it's definitely not. So where would you be pounding the table?
Well, I did remember the musings 2 weeks ago was
Yeah.
entitled "Never Let a Good Crisis Go to Waste." And that was not a Barton Biggs quote. That was a Winston Churchill quote. So
Yeah.
going really back to the stars of good quotes. Winston Churchill had many, and that was one of them. And I made the case then that Europe was a great opportunity, both tactically, so in the near term, and strategically in the long term. And tactically, valuation is very compelling. Europe's trading at 12 times forward earnings. Earnings expectations are very modest. I think consensus earnings growth is like 6% in Europe. If Europe grows anywhere close to 3% real growth, that earnings bar is going to be met and surpassed very easily. You had record fund outflows. Again, going back to the B of A fund manager survey, they showed that chart where outflows from European equity funds just, off the charts. It was so bad. It was by far the record. So people have sold out. Valuations are cheap. You have a great policy mix. The ECB, I think, is going to be very slow to raise rates. I don't expect them to raise rates this year. The market is already doing some of that for them, right? With the bonds, as we just talked about, at 45 basis points. You have fiscal support, not only from the next gen program that was put in place to deal with COVID and to help move the economy to green energy, which is going to really come through in 22, 23, and 24. You also have now the additional fiscal spending of Germany and others to deal with energy security and defense.
And defense, yeah.
So you have a very solid backdrop in Europe that, as far as I can tell, everyone's out, markets are cheap, earnings expectations are very low, policy is very supportive. I mean, me, and then that's the tactical case. Strategically, I believe, and that our tripolar world framework is something that we think really differentiates us here at TPW, which stands for tripolar world, right? Our view that regional integration and regional cohesion in Europe, Asia, and the Americas is the mode that we're moving towards globally, geopolitically and economically. And everything that Europe is doing is moving it in that direction of a ever more integrated, cohesive, strong European economy and financial markets. And if they're able to move forward in the joint financing of the energy security and defense programs as they did to deal with COVID, right? Next Gen is financed by joint borrowing by the EU. If they build on that for energy security purposes, then you start to develop a European bond market as opposed to depending on the bond market as a risk-free asset in European fixed income, which is a horrible thing because the German bond market is tiny. It doesn't, it's a tiny market because they don't borrow very much.
They don't borrow,
you need a European bond market, and I think we're moving to getting one, which then supports the euro. And everyone's talking about, what does all this freezing of reserves and things mean for the dollar, et cetera, et cetera. I think the euro over a multi-year period is going to do quite well in the coming years. So strategically, if you're a 5-year investor, a 3-year investor, a 10-year investor, if you're a pension fund, insurance company, et cetera, you should be loading up on European equities right now because you have the rare situation where both tactically and strategically, there's a really nice opportunity. So that was one opportunity we mentioned, again, 2 weeks ago. And we also mentioned the thematic high beta space as being an area we wanted to start to dip our toe back into. And we did that with our most recent global multi-asset model update. Now, 3 weeks ago, we took our first step back into the disruptive tech space. And to me, this is best represented by ARK and Kathy Woods in the ARKK ETF. But it goes well beyond that to the different themes that are built into the ARK ETF. So whether it's fintech or climate or the things that we've discussed, many times on these live sessions, I think they have been through their bear market, right? ARK peaked, to use it as an example, in February of last year, over a year ago. Been in a bear market for a year. It collapsed 70%, peak to trough, from 160, I believe, to 60, or 52, I think was the actual low. And so valuation there has gotten very compelling again. You have the ARK portfolio, which is growing revenues at 40% per annum, trading at roughly 7 to 8 times sales. 7 to 8 times sales for 30 to 40% revenue growth is pretty compelling. And so to me, there again, valuation is supportive. Sentiment is absolutely horrible. You can't mention Kathy Woods without people, turning up their nose or, laughing. Sentiment is horrible. Positioning, a record short position in ARK 2 weeks ago. Record short at $60, not record short at 160. Record short at 60. So, I mean, I think that's the time to look into that space right now. Is pretty compelling, particularly if we're right on our view that the 2023 to 2025 period is going to look like the second half of the 90s in the US, where you had better than expected growth driven by a CapEx boom. Again, everything that's happened in the last month has supported the idea of a global CapEx boom. Energy security, defense, infrastructure, climate, I mean, you name it. So CapEx boom is, I think, pretty much guaranteed at this point. Productivity surge because of technology, ever more visible, and I think going to become more and more visible as COVID lifts, and people can start to pay attention to this. And that allows for unit labor costs to go up without big inflationary pressures, which means people have more money to spend soon. So if we're right that outlook is going to be the one that we see in the next 3 to 4 years, then the disruptive tech space, the high growth, high beta space, is going to be seen as a tremendous opportunity in hindsight, right? Because we're not going to know about the growth until a year or two down the road. But if we're correct, these stocks are not going to trade anywhere close to where they are today. And if we're wrong, they've already had their bear market, already down 70%, already record short positions in them. So we like the risk reward there. And those were two opportunities we identified 2 weeks ago. And then on Friday, we came up with two more. I just have to have a sip of water. Been talking for quite a few minutes there in a row. But so Friday, we came out with two more. One is China, right? As we've touched on. Again, widely disliked, huge outflows over the last month or two, declared uninvestable by one of the top banks in the world. Can't get better than that. Trading at 9 times earnings. The Chinese stock market growing, the economy likely to grow at 5% this year. Selling at 9 times forward earnings, the cheapest it's been versus the world in 20 years. China has never really been cheaper since it's been like a functioning market that one could invest in. It has never been cheaper than it is right now. And you have the policy mix, which is even better than Europe's, because you have the central bank easing, you have fiscal policy ready to go, you have the government just stepping in publicly, globally last week saying, we're going to support the market. And they have every capacity to support the market. So to me, I don't know if it gets much better than that opportunity. And I am talking our book. We are long and overweight China, and we have been for several months. So I am talking the book, but I also do think that there's a lot going for us with that point of view over the next 6 to 12 to 24 months. Maybe not over the next 6 days, but again, even with China, they had a huge rally last week, as we talked about, right? K-Web up 40%, and today it was down 5%. That's the way it's gonna be very choppy in big swings, but I think the direction of travel is up. And then the last opportunity that we talked about was gold, and we actually included in our musings a link to another macro thinker and advisor, Kevin Muir at Macro Tourist. And he's a very nice guy, and he okayed us including his link in our piece. And he really he's done the best job that I've read so far of what the implications are potentially of this freezing of Russia's central bank reserves. And, a lot of talk about the dollar being no longer, the leading currency. I think that's all kind of just talk. I think
it's an exaggeration, totally, yeah.
Yeah, I think what's interesting is the opportunity for gold, right? Gold arguably is already looking quite good technically. People don't own enough of it if you look at the central banks of the world. And if the central banks decide that, hey, we should have a little bit more gold, and not just because of, that they're going to get on the wrong side of the US or what have you, but just as a hedge, as a diversification. And Kevin laid out what would happen if China, because China obviously has the most reserves, $3 trillion of reserves, much of it in US dollar treasury paper. And so if China decided that, hey, we should hedge ourselves a little bit and put 25% of our reserves into gold, Kevin went through what it would mean in terms of China owning, the various public ways to own gold, and all the gold ETFs, gold mining shares, everything. China would absorb all of that by trying to get to 25% of its reserves in gold. So the point being that there's the potential for a sizable buyer for years underneath the gold market. And I just thought that made an awful lot of sense to me. It may not be 25%, it may not be, maybe 10, maybe 5, maybe 8, Right now, China has 3% of its reserves in gold. And I think if you think about the next couple of years, is that likely to halve or double? I would say double, probably triple. And therefore, that's a big buyer that's going to support the gold price. And it takes a lot of work to get more gold and to mine more gold. It's not that easy. And so I thought the idea made a lot of sense. I urge you to read it. It's on the OHM site. It's a link in our musings. You can read the whole piece, thanks to Kevin. And so I think gold is another opportunity. And there too, I would just note that we have a nice 4% position in the GDX gold miners in our global multi-asset model portfolio. So we are exposed there as well. And I think we're going to do quite well. And I noticed that GDX was up another 2% today. It's on a nice run. And I think it can continue. Again, strategically, over the next year to 2 years, I think gold is likely to be, go considerably higher, in line with the other different commodities, which we're bullish on the whole commodity base. We have a very big, almost 20% of our global multi-asset model in commodities, whether it's energy, agriculture, precious metals, industrials, metals. We're exposed across the board.
This is very interesting, Jay, and I could not agree more. Well, number one, we have just launched a commodities portfolio, which are comprised of some local stocks like Vale, of course, but some of them are BDRs, the international stocks listed in Brazil. And I have written an article for Brazil Journal. Maybe I'll have it translated about, on the back of what's happening with the war in Ukraine and the freezing of the Russian reserves, and what could happen, in terms of having a dual monetary system, one, led by China and the other one led by the West. Although this could be way out there, but what I mentioned in the article that has to do with what you said, it's the fact that for that to happen, China will need some of the Arab oil producers to sell, at least when they deal with China, sell that in yuans. But for that to happen, China is trying to create a liquid market in Hong Kong where it could swap those yuans for gold. So then China would need to buy gold for that, because they have to convince the Arabs, okay, we're going to pay you in yuans, but in case you don't want them, you can swap them for gold in Hong Kong. So that's why they may, for them to have a slight chance of achieving that, they would have to, to pile up a lot of gold.
Yeah, that's an interesting thought, and I think your timing on the commodity fund there is, is well timed. But from my point of view, the issue for China is that its currency is not convertible, and until its currency is convertible, the current
account is closed.
Yeah, until it's convertible, it's not going to be a major player in terms of global currency markets. And, when they decide to let it be convertible, I think that will be a very good thing, because it would suggest that they're not worried about people immediately, taking their money and hitting the exit, which is what happened in 2015, the last time really China talked about kind of moving towards convertibility. And that was an experiment that didn't go particularly well. So I don't expect that anytime soon. And then the issue about the Saudis and others buying, or selling their oil from RMB has been around a while. And the issue there becomes very quickly, what are the Saudis going to do with all that RMB? What are they going to do with all that yuan? They don't need it. They don't buy tremendous, the trade flow is very one way. So they all of a sudden they have a huge pile of RMB that they can't do anything with. So I think when you kind of work through the steps, you realize that a lot of this stuff is just talk, and it may move that way, but it's going to take forever. And gold is something that can be done today. and
No,
without
no,
going
no.
through
I totally agree with you.
all these different machinations.
I didn't say that to say I disagree.
Yeah.
And
No, no,
I,
no. I'm giving you
yeah.
my 2 cents. Yeah.
No, no, no. Of course, and I know this. You know, it's a humongous task, and it's a very a big uphill battle. And this gold thing is only one of the obstacle they need to overcome for the renminbi to have a slight chance of becoming a reserve currency. The other one is them opening the current account and basically letting the currency be convertible. So I mean, it's a long way, but I totally agree that this is going to put on floor. I mean, it has already put maybe a floor on gold.
Yeah, and people are not, people aren't really heavily invested in gold, right? I
Yeah,
mean, people are in Bitcoin, which hasn't really worked as a
as
inflation
a hedge.
hedge.
Yeah,
But people are not in commodities. I mean, the single best move of the last couple of years from a global asset allocation point of view has been to sell bonds and buy commodities, right? I mean, that has been the trade of the last couple of years. And I wouldn't say we nailed it perfectly, but I can say that we have been massively underweight fixed income and significantly overweight gold. Our benchmark in our global multi-asset model is 50% ACWI, 40% Barclays Ag, and 10% Goldman Sachs commodities. And we're at 19% commodities right now, so virtually a double. And we're at less than 20% fixed income, so less than half of our benchmark. And that's been one of the reasons why we've been able to kind of maneuver through the equity correction without a lot of pain, because the other pieces, the other parts of the bucket, the other buckets of the whole pie have done, very well relative to their benchmarks. And so I think that's, I continue to feel like, people are very bearish, people are very worried, but I think the opportunity set is really around the world across different assets. You can really make asset allocation and investment decisions that will differentiate you from the benchmark. And this is after a decade where the only trade was to simply go long US tech, and that was
yeah.
it. And fighting against that trade was painful. And I know because I've been doing it for a long time. And it has been very painful. But now I think it's truly ebbing and changing. And, as a global asset allocation guy, as a multi-asset guy, I think there's just a lot of opportunities out there. And I'm excited. As I wrote in my musings, I said I was energized after last week. And, I really feel that way. I mean, this is fascinating times, and arguably, yes, hard to stay abreast of everything because things are moving very quickly. But by the same token, we have not made a lot of moves in our model portfolio this year, right? We have not sold aggressively out of equities. We have not maneuvered aggressively around energy, even though it's had all sorts of big moves, right? As you know, we were talking about long XLE in the fall of 2020. Forget about 2021. And so here we are, we're still with those positions. So if you have a well-constructed portfolio, you have been able to ride through this period without huge, downdrafts in your portfolio, and that gives you comfort to think that okay, we can, we're positioned okay, we're kind of balanced, we're underweight bonds, overweight commodities. Within equity, we think there's loads of opportunities out there. And if we get through this, if we get through the Russian-Ukraine, if we get a ceasefire and people finally can start to focus on kind of a normal outlook about growth and inflation and things of this nature, and COVID reopening, that this latest variant, I don't think is going to create big lockdowns. I think we're going to ride through that as long as hospital systems don't get overwhelmed. That is going to be an environment that people are going to kind of wake up and say, wow, 6% earnings growth in the S&P this year, 6% earnings growth in European equities this year, China trading at 9 times earnings. ARK at $60, et cetera, et cetera. I think people are gonna, we could be setting up for some really interesting moves here in the next couple of months to the upside.
Mm. No, fully agree. So, as you say, let's, keep calm, carry on, stay focused, and I agree. There's a lot of opportunity, and yeah, we're right up, at the mark. So thanks again, Jay. It's been great. We covered a lot on this one, and I look forward to the next one 2 weeks from now.
I know. I mean, these 2 weeks, like we talked about, it seems like it's 2 or 3 days, but it's always a pleasure, Roberto. Great talking with you and with your audience. And indeed, we will keep calm and carry on. Till next time.
Yeah, likewise, and enjoy spring. Happy spring.
Thank you.
Thank you. Bye bye.
Bye.